Can you guess the number of times Congress has avoided a shutdown in this budget cycle? The answer might surprise you. The Congress has found itself at the brink of a shutdown not once, not twice, but 4 times in this budget cycle. Just today, they narrowly avoided the 4th shutdown. But here's the catch. This respite is only for another week. Now you might be wondering why it's taking so long for a full budget to get passed. Well, the answer lies within the chambers of Congress itself. To pass a budget, it must receive a green light from both sides of the aisle, the Democrats, who have control of the Senate, and the Republicans, who hold the majority in the House of Representatives. The leaders of these chambers have managed to agree upon a spending limit, marking a significant step towards reaching a compromise. However, the devil is in the details. They still need to decide how this money will be distributed. This has been a major sticking point, with a faction of Republicans advocating for substantial cuts in spending for social programs. So, what happens if the two parties fail to find a middle ground? Well, the clock is ticking. Without a consensus, funding will run dry for some agencies as early as March 8th, with others following suit on March 22nd. The situation underscores the importance of bipartisan cooperation in managing the country's finances. It also highlights the fact that the budget isn't just a document detailing government spending. It's a reflection of the nation's priorities and the political will to support them. So the Congress has a week to hammer out the details and reach a consensus. The consequences of not doing so could be dire, impacting everything from social programs to government operations. It's a high-stakes game of political chess, with the nation's financial health hanging in the balance. So the clock is ticking. If common ground isn't found, funding will run out for some agencies on March 8th and others on March 22nd. January saw stubborn inflation, but don't worry just yet. Some Federal Reserve officials see this as a temporary blip. So, let's delve deeper into this view. 2 key figures in this discussion are Atlanta Federal Reserve President Raphael Bostic and his counterpart in Chicago, Austan Goolsbee. Both are optimistic about the fight against inflation and predict a downward path. Let's start with Bostic. He has been consistent in his belief that inflation will cool down. Speaking at a recent event in Atlanta, Bostic reiterated his previous expectations of a summertime cut in interest rates. He pointed out that the recent Personal Consumption Expenditure Index, or PCE as it's often called, showed inflation's downward path is still intact, albeit a bit bumpy. In his words, the last few readings have come in higher than people have hoped, but if you look over the long arc, the slope is still coming down. It's like a hiker descending a mountain, he suggested. The slope might not be as steep as before, but it's still a descent, and that's good news. The challenge now is to ensure it stays that way. Now, let's turn to Goolsbee. He was speaking in an online presentation to Princeton University, where he cautioned against reading too much into a single month's data. The main thing to see is that we've had very substantial progress over a long-term basis, he explained. Goolsbee highlighted progress in the core PCE for services, which are more closely tied to labor costs. However, he also acknowledged that housing inflation remains persistently high, a factor that's been somewhat of a surprise and a puzzle for economists. Both Bostic and Goolsbee's views underline the importance of the PCE index. It's a measure of the prices paid by consumers for goods and services, and it plays a crucial role in the Fed's decisions on interest rates. If the PCE index shows inflation is easing, it could signal that the Fed's efforts to cool down the economy are working. But, as our 2 Fed officials point out, the path of inflation can be bumpy. There can be ups and downs in the short term, but it's the long-term trend that matters. And that trend, according to Bostic and Goolsbee, is heading downwards. So what does this all mean for you? Well, if these Fed officials are right, and inflation is indeed on a downward path, then we could expect to see a decline in the cost of living. Prices for goods and services might start to fall, and interest rates could follow suit. That could be good news for your wallet. Despite a few bumps, the fight against inflation is far from stalled. The slope might not be as steep, but it's still on a downward path. So keep calm and carry on. The Fed's got this. Ever wondered why housing inflation hasn't improved as much as expected? You're not alone. In the grand scheme of inflation, housing seems to be an outlier, a stubborn variable that's puzzling economists and policymakers alike. Austan Goolsbee, a prominent figure at the Federal Reserve in Chicago, recently posed the question, why hasn't housing inflation improved more than it has? A question that's been echoing in the hallways of economic institutions across the nation. Goolsbee's remarks come in the wake of a broader discussion about the trajectory of inflation. While the overall inflation trend is showing signs of a downward path, housing inflation isn't playing by the same rules. Despite some progress, it's still running significantly hotter than before, raising eyebrows and prompting a deeper investigation into the underlying factors at play. Just when you thought it was safe to go back into the housing market, mortgage rates are inching closer to 7%. In a turn of events that has left potential homebuyers on the sidelines, mortgage rates have been creeping up, edging ever closer to the 7% mark. This is a significant shift, seeing as it was just a few months ago that we saw a downward trend in mortgage rates, sparking a resurgence of buyers eager to capitalize on this opportunity. To put this into perspective, let's take a brief trip down memory lane. In the not-so-distant past, October to be exact, mortgage rates reached a high point. This peak was followed by a steady decline, which acted as a magnet, attracting more prospective buyers back into the market. However, the dream of affordable home loans appears to be fading. Over the last 4 weeks, rates have been on an upward trajectory, causing a noticeable shrink in the pool of potential home buyers. The housing market, known for its fluidity and unpredictability, is once again proving that it's a living organism, constantly reacting and adapting to the economic stimuli around it. This recent increase in mortgage rates is not an isolated event, but a response to a myriad of economic factors. It's a ripple effect, resonating from the core of our economy. We can attribute this development, in part, to the stubborn inflation that has refused to back down, despite the best efforts of Federal Reserve officials. The rise in mortgage rates is a clear illustration of the interconnectedness of our economy. The battle against inflation, the housing market, and mortgage rates are all pieces of a larger puzzle. Each component influences and is influenced by the others, creating a dynamic and ever-evolving economic landscape. Now, with rates inching closer to the 7% threshold, the number of potential homebuyers is dwindling. The housing market is in for an interesting ride. The question that remains is, will this upward trend continue, or will the rates take another turn? Only time will tell. The economic landscape is ever-changing, and so is the fight against inflation. We've delved into how Congress is grappling with budget deadlines, with the potential for significant impacts on various sectors if common ground isn't found. The Federal Reserve officials' perspective on inflation, despite its stubborn persistence, remains optimistic. They maintain that the downward path is steady, albeit bumpy, and caution against drawing conclusions from isolated data points. We've also explored the curious case of housing inflation, which seems to buck the overall trend and remains a hot issue. With mortgage rates inching closer to the 7% mark, this could have considerable implications for potential buyers and the housing market at large. These are not just dry economic discussions or abstract numbers on a page. They are the pulse of our economy, shaping our lives in tangible ways. Stay tuned and keep an eye on these developments. They're more than just numbers. They're the heartbeat of our economy,